Yeah, you debit the organization expense and then you credit the common stock.
Share screen. I hope this is working this time.
Huh?
Huh?
Let's go.
I said, I hope it's recording my screen this time. It didn't share the screen last time.
That's why I said let's hope.
Oh, let's hope. Sorry, I didn't hear you. Okay, we went through the pages 12 through 14, top of 14, and filled in the blanks. So now we'll just start going through dividend examples. Did y'all remember any of it, or really we're kind of go through it. We're gonna, I mean, you can fill in the blanks and everything, but once you start applying it, it'll start meaning more to you anyway. All right, remember there's two different kinds of dividends that can be paid out: cash dividends or stock dividends. Cash is they pay stockholders cash. Stock dividends are actually distributions of shares of stock. And remember, let's go back real quick. There are important dates. So we're going to have the date of declaration, the date of record, and the date of payment whenever you see a dividend payment. The date of declaration means that the board of directors has approved and declared this dividend, they're going to pay it. This is the date that their legal obligation begins. They are liable for these dividends on the date of declaration. Date of record just is the cutoff date. It's like whoever's an owner on this date will get the dividend. Anybody who buys stock after this date, they will not get this particular dividend. And then the date of payment is when they pay. All right, it's real similar with stock dividends. The date, you have to have a declaration date. That's when they become liable to distribute the shares. Date of record is the cutoff date. So anyway, just keep that in mind. Okay, so this first example is going to be a cash dividend, and these are relatively easy, so enjoy it. And the way I've written these examples in the same way that they're written in your homework and in the book, so that you can kind of get used to the wording. They're telling you on the example here, the declaration, record, and payment dates in connection with the cash dividend of $80,000 on Hanover Corporation's common stock are September 1, October 15, November 1. So they're giving them to you in order. This is our, and they're going to be in chronological order anyway, because you have to declare the dividend, then you have to have a cutoff date, then you pay it. So you've got your date of declaration, your date of record, and your payment date. So we need to journalize the entries required on each date. If no entry is required, you need to enter the date and no entry required. I think you have to do that on your homework. Okay, so September 1, we have the date of declaration. So they're liable for it at this point. So we've got to record it. So we will debit cash dividends. And what this is that's an equity account. It's real similar to drawing. Did you get good news? Okay, good. Message me. All right, I'm recording. Let's go on recording. Message me, tell me what they said. All right, so cash dividends, it's like withdrawals. It's part of the equity section. And of course, I'm saying it's like withdrawals, but I'm trying to help you kind of associate it with something that's, it works kind of like draws do for sole proprietors. So this is a corporation, and you've got lots of owners. So this cash dividend account will show up in the equity section. So we're going to debit that account for $80,000. That's the amount of the dividend that's been declared. And then we will credit cash dividends payable. So what kind of account would you think cash dividends payable is?
It's a liability.
It's a liability. So how do you know that?
The payable.
The payable, okay. Just checking you. do remember some things from accounting one. All right, so our date of record is October 15th. That's the date that they cut off for purchase of stock, shares. Anybody who is a shareholder after October 15th will not participate in this dividend distribution. There's no entry required. I don't really know what you would do because it's more of like a record of who owns the particular shares of stock. All right, so our payment date is November 1. And so we'll debit our liability and credit cash. So this one's pretty easy. All right, so the next one is one of these. You work this one, so y'all take a quick stab at it and see what you come up with. Huh?
I said, what was the last one?
I can leave it because you're working off your own paper. I'll leave it anyway. And we get to stop doing this. It gets kind of interesting.
So there will be nothing organizational expenses like that.
I'm not planning on it. Because I'll be honest with you, I'm sure it happens, but it's one of those that's more of like, I've never seen it happen. I don't know that I've ever seen it happen at all, but I'm sure it does. But, it's just not something that you're going to encounter on a regular basis. So I would rather you learn the stuff that's more common. Now you have heard about what to do with it if stock is issued, but I don't necessarily think it has to be included on the test. It's not as common. So, all right. So,
like if you were going to work for a corporation, maybe you go.
Yeah,
Or
maybe.
working for like smaller businesses or government employees, stuff like that. You're not going to see that. So for the second one, so like say if we're doing this on a test, like would you actually write no entry required for the second one?
Yeah.
Okay.
And I'll have that in the directions. If there's no entry required, write no entry required. I don't even know if you'd see that for a big corporation like that. It's not often that they're going to trade shares of stock for something like that. You might see that with a brand new corporation starting up and maybe they get a good sales pitch and they talk this attorney into doing their work for them for some shares of their stock. You know what I'm saying?
Yeah.
I don't know that I've ever seen shares of stock traded for assets like land and buildings. It may happen. I don't know. I'm not saying it doesn't happen. Maybe it happens other places, not here, and I just haven't seen it. So,
It's sort of like investing in the company.
yeah. Oh, it's definitely investing in the company. Because if you were to liquidate your assets, you'd have cash. So, you're essentially just skipping the sales part of the process to convert your assets to cash to buy the stock. So, it's the same thing. All right, so on January 14 on this one, y'all done? This one's easy, it shouldn't take long. Cash dividends, $55,000. Cash dividends payable, $55,000. All right, and then no entry required on the 20th. And then for the 10th, we're going to debit the payable and credit cash. For the $55,000. Oops, hold on.
Sign the first last one. Isn't it the printing page? Not this one, the first. Isn't it the-
Oh, I didn't finish. Or either I hit it and wiped it off. Yes, you should have. So my first entry should have been a credit to cash as well on the November 1st. Okay, stock dividends. The stock dividend is a distribution of shares of stock to stockholders. It's normally only going to be declared on common stock issued to common shareholders. So you won't really see preferred shareholders getting stock shares. Not as common anyway. There's no cash being paid out. So the only area of the books that'll be affected, or the balance sheet, will be the equity section. However, your total equity will stay the same. We're just shifting things around a bit. Okay, so on this first one, we've got Hendrix Corporation on December 15th. They've got $20 par common stock, 2 million shares issued. Where'd this number come from? The 40 million. How would you get that? Yeah. At some point, I can't remember exactly when it hits us. It's either next chapter, it may be somewhere in this chapter. I think it's next chapter. Or it may be when we're doing retained earnings statements or stockholders' equity statements. They'll give you par and they'll give you this, but they won't give you the shares. Just divide. Just think about how that even gets there. When they issue stock, they debit cash, credit common stock times the shares times par. And then the difference goes in paid in capital. Did y'all get that? With the, I got distracted by the concept. Did you follow? Remember when you sell shares of stock, you're going to debit cash. If it's sold for something other than par, you're going to credit. It doesn't matter. Even if you sell them at par, common stock has par times the number of shares. So if you've got par, you got the par amount, and you got the total, you can come up with your shares. That stumps everybody when we get to that. When we get to that place, is how do you get the number of shares? Sorry. I guess I need to turn that off. I don't know how to turn it off when we're recording. Okay, so on December 15th, Hendrix Corporation declares a stock dividend of 5%. And then I tell y'all what that 5% is. So here's the stock dividend, and it's 100,000 shares. And how I got that was taking the 2 million shares up here times 5%. So they're going to distribute 100,000 shares. Now, January 10th is the date of distribution. So instead of payment, we'll be distributing. We're not giving out cash, we're giving out shares. So it's the same concept. You're sending them out on the 10th. So that's our issue date. Let's see. The 15th is our date of declaration, because they're saying on the 15th they declare a stock dividend. All right, and then to stockholders of record on the 31st. So there's your date of record. So you need to be able to pick all these things out. All right, this one's a little more fun. All right, so we declared a dividend on December 15th. So that's the date we need to record the dividend and the liability. So this one is called stock dividend because it's a stock dividend. And it is 100,000 shares. What do you think? Times what? How about that? Market price is 31 per share. So what do you think we're going to do there?
The $31.
The $31. If they were giving out cash, the thing is too, I mean, they're giving out 100,000 shares. If the value of these shares on the date they declare the dividend is $31, and if they turned around and sold them and gave them cash, it would be the same amount. So you're going to value it using market price. So 100,000 shares times $31 per share. So that's where that came from. All right, so we've got 3,100,000.
Yes.
Don't know why I did not write my answers down. I didn't do them ahead of time. Just wasn't on the ball today. All right, so we will credit. See how small I can write. Stock dividend distributable. We ought to have a contest and see who can say it the most times without fumbling.
Let's not give it a distributable.
Distributable. You have to really focus. All right, so we'll kind of do with this, like this is going to be what we credit common stock for. We are not going to credit common stock until those shares are issued to the shareholders. That's when you credit common stock. So right now we're just showing it as a liability. We've got to distribute these. So we're going to credit this distributable account by par. So we'll take 100,000 shares times, what is my par? $20. And that is up there in, I almost have to do this underneath because it takes up so much room. Okay, so we got 100,000 shares times the $20 par. So we're going to credit this liability $2 million. And ultimately, when we send the shares out, we'll take it out of there and put it in common stock. Okay, so what do you think the difference is going to go to? You can do it. Just take a stab. Y'all seen it so much.
It's not paid in pesos or stock dividend.
Yeah, there you go. What'd you say?
Never mind.
I had 4 or 5 voices going. All right, it's going to go in paid in capital.
Excess stock dividend.
In excess of par common stock.
Yes,
Oh,
see?
really? That's it?
Oh no, you got to write it out. Go to the labels and copy and
Yeah,
paste.
no, that's what I
them.
did. I was like, I'm not
Don't
writing
try
this
to
down.
type it in. Go to the labels and copy and paste. Y'all know that from last semester. That's a nightmare. If you don't put it in exactly like they have it, you're not gonna get it right. You should always copy and paste. All right, so that'll be my difference of 1,100,000. And that's how you record the declaration of that dividend. Now, yeah. So now we've got the date of record, and that's December 31. You can skip a line or not. I do that because it starts getting cluttered. No entry required. That one in the middle will be your easiest one of all. So when you're taking your test, if you don't know anything else and you know that the date of record, there's no entry, put that on there. That's 2 points. Y'all got to be smart. You got to take your test smarter. Y'all did good on the first one. Y'all did listen to what I said and kind of put down the things you knew instead of just throwing the towel in and forgetting about it. Which I understand getting frustrated, but I mean, get all the points you can. I do get frustrated. All right, so January 10th is the date of distribution. So we will debit that liability, stock, dividends, distributable. And that was 2 million. Because this is our par amount. And now we're going to show these shares and common stock because now we have issued them. Does that make sense? You kind of got to think about why we're doing it this way, because there for a while, even I was going, what do we do in this for? You know? And then, you know, because we're not going to show these in common stock until they're actually issued. So you have to show them as a liability for that common stock piece. And because there for a while I was getting confused trying to put the paid in capital down here. But this is the way you need to do it. All right. So a stock dividend is not going to change your assets and liabilities or your total stockholders' equity. It's just moving stuff around. And it also is not going to change an individual stockholder's proportionate interest. So let's say you own 10% of this company stock and you get a stock dividend, so you get more shares. You don't have more than 10%, you've still got 10% because everybody else got shares too. So I put a example on here so I could kind of show you it works better for me if I can kind of see it. All right, so we're going to assume that a stockholder owns 1,000 shares of a corporation's 10,000 outstanding shares. If the corporation declares a 6% stock dividend, the stockholder's proportionate interest will not change. So the total shares issued before the stock dividend is 10,000. And this owner's his total is 1,000. So how much does this owner own? He, she, whatever. How much is that?
10%.
10%. Okay, so let's see. There's a 6% stock dividend. So 10,000 shares times 6% equals how many total shares?
600.
600 total stock dividend. So after the stock dividend, you'll have 10,600 total. So what is this shareholder's piece of that 6%? What's 1,000 times 6%? 60. So now this shareholder has 1,060. So how much does the shareholder have? What percentage?
10%.
Huh?
10%.
It's 10% because I told you, but if you multiplied it out or divided it out, you're still going to get 10%. So that's kind of proving it to you that even if they get stock instead of cash, they're still going to have the same amount of ownership. But the idea is that those shares will probably appreciate and they can sell them and then they can get cash. Or they can turn around and sell them right then and get cash if they want. Okay. So here's another example of recording stock dividends since it's kind of different. It's a little more complex. We have this company named Vienna Highlights Corporation. They have 150,000 shares of $100 par common stock outstanding. It's a lot of words. All right, so on June 14th, they declared 4% stock dividend to be issued August 15th to stockholders of record on July 1. So there's all your dates. The market price was $110 per share on June 14th, which is the declaration date. All right, so we're going to journalize the entries. June 14, July 1, August 15. So on this first date, well, first of all, let's figure out how much is the stock dividend? They have a total of 150,000 shares times 4%. So how many shares is that?
6,000.
Okay, so it's a 6,000 share stock dividend. Okay. So on the date of declaration, we are going to debit stock dividends what are we going to do?
Multiply that 6,000 by 100. No.
Yep. It's 6,000 shares, which is the stock dividend amount times market value. So how much is that?
660.
660? I actually have these marked. All right, so what are we going to credit?
Stock dividends distributable.
I'm making me y'all say it. All right, stock dividends distributable. I'm going to abbreviate since y'all know what they stand for now. 6,000 shares times what?
100.
Times par. So $100 par. Okay, 600,000. And then where's the difference go?
You can see it
paid in capital in excess of par. $60,000. Okay. So on the date of record, which is, what's the date of record? July 1, no entry required. All right. And then on August 15th, that is the distribution day. So we will debit our liability account, stock dividends distributable. That did not go well. I was trying to write it out. That did not go well at all. And then we will credit common stock because now we have issued the shares. So that is 600,000. I had to look at that word again, make sure I spelled it right. That making sense? Somewhat? All right, y'all work through this next one. See if you can do it. First, you got to figure out how many shares you're distributing. Not that I need that much money. What y'all get for stock dividends?
283,500.
283.5. And then what about distributable?
105,000.
What about paid in capital?
178.3.
3?
No, 5. Sorry, I can't read.
Your own handwriting. All right, then no entry on that April 5th. Then for May 15th, we'll just take that liability and remove it and then show that the shares of stock were issued. That make sense? Yes. Really? Good. I figured it would make it confusing, but it probably will after it gets cold. And all right, so stock splits. A corporation may use stock splits to reduce their market price, like if their market price is too high, or they might do it to reduce par. There's a variety of reasons, but it's quite normal and common to see companies issue stock splits. And the way it works is like, let's say you have 1 share of stock and they do a 2-for-1 split. Well, now you've got 2 shares. Now the total of those 2 shares as a result of the split will be the same value, but as time passes, your hope is that they go back up in value. So you'll have 2 shares, one you didn't have to purchase, and you'll have more value because of the split. That makes sense? It could be like, and I've seen them like 2-for-1. I've seen 3-for-2. Like if you have 2 shares, they'll give you 3. I don't know. I guess it depends on what their goal is as far as getting the price down and diluting their par value. But this is just showing you how it works. It's kind of like that last one we did with the stock dividends. Make sure you're aware that stock splits apply to all common shares if they're not issued yet. So they're authorized but maybe not issued yet. If they're issued, and then Treasury shares, which are shares that the corporation has bought back. So any common shares, if they split, you're going to have, 2-3 times as many depending on what the split is. All right, Robertson Corporation has 12,000 shares of $50 par common stock outstanding with a current market price of $75 per share. The board of directors declares a 2-for-1 split. Now, how will the stock split affect the number of shares and the par value per share? Okay, so we're starting out before the split with 12,000 total shares with a par value of, 50. All right, so how much is that in total? Our total common stock on the books. Par value times shares. How much is that?
600.
It's 600,000. Okay, so after the split, if you now have 2 where you used to have 1, how many do you have now?
4,000.
You got twice as many. So now we have 24,000 shares. Our stockholder equity is not going to change. We've just got more shares. So what would our par be now? not 50 anymore. If you multiply 24 by 50, you're gonna have 1,000,002.
25.
So see, nothing changed except for them just giving out more shares. So they're making one share be 2 now. So you have to split the par in half as well. Because you're still gonna have 600,000 total. Because no money has come in or out. And, you haven't issued any shares, you've just split the ones that are there. Yeah.
Okay, so you double the number of shares. With the primary share.
Yeah, because what you're doing is they're not giving out more shares, they're splitting the ones that are there. So it's like taking your apple and cutting it in half. You still have an apple, but now you got 2 pieces instead of 1 piece. So so think about these, they're splitting them in half. So now we got 24,000 pieces, but we didn't change the total. I mean, if you got 2 halves of it, you still got the same number of whole apples. Does that make sense?
Yeah.
So 600 is not going to change. So if you divide that 600 by 24,000 shares, the par comes out lower. Okay? Make sense?
So
You're not going to have a whole lot on that. You might have like a multiple choice or 2, but it's not going to be like a majority of your test. So.
if someone wanted to sell their shares, so then they would have to sell it after the price for like after the split.
Yeah. If they turn around and immediately sell their shares, but the thing is, even though the market price is going to lower, you've got twice as many shares as you had before. So it depends on how much it drops. They still get the same amount of money. So, but over time, as it appreciates, that's when the difference, that's when it makes a difference to have the extra shares. So anyway, okay, Treasury stock transactions. Let's just go through this real quick. That'll save you some time. Treasury stock is stock the corporation has previously issued to shareholders, but they have bought them back. So that's what reacquired means. They have turned around and purchased them back. Now, they have to pay the same price that anybody else does when they buy them back. They don't get a bargain on them or anything. I mean, if you bought some shares of stock from Nike and then they want to buy them back, are you going to give them a discount? No. Just like they don't give us, I don't necessarily give us a break on some shoes or something, are they? Unless they're having a sale. All right, so why would a company buy their shares back? Well, there's multiple reasons. They might want to have some shares on hand that they can sell to their employees.
Is that say prices? Is that not supposed to be the base price?
The what?
It says price stock.
To support the
It should be like base.
market price. Sorry. Nobody caught that last class. They weren't paying attention. It's supposed to be market, sorry. Or either I did catch it and I just wrote it down wrong. To support the market price of the stock. Or to give bonuses to employees by way of shares of stock. So like, let's say maybe the market price on the corporation's stock has gotten low. They'll buy a bunch of shares back so there's not so many out there. Law of supply and demand, if they're not out there, the price may go up. That's what they're hoping for. So buying some of them back, holding on to them until the market price, recovers or whatever. That's part of it. Maybe they want to, maybe they've decided to make their employees company owners. So they want to distribute shares of stock to the employees as sort of a bonus. So that'd be another reason. So it just depends, could be different things. All right, so we will use the cost method to record these shares of stock when they're bought back. So all that means is whatever it is that they have to pay for these shares of stock, that's what we're going to record them at. We're not going to use par for the treasury stock because we're having to buy them back at this is different, This is not like in the initial stock issue. So let's say they buy back $50,000 worth of treasury stock. They'll debit treasury stock $50,000, credit cash. Treasury stock is going to show up as a debit balance in that equity section. So it looks funny. If you don't know what treasury stock is, and maybe you're looking at somebody's balance sheet and you've got this treasury stock account and it's got the wrong balance in it. You know, we're looking for all the credits because that's what capital and equity, their credit balances. Treasury stock's got a debit balance. So it does look funny if you don't know what you're looking at. When they resell the stock or maybe they give it to the employees or whatever, it's going to be credited at the same per share price that they had to buy it back for. So that just makes sense. We want to get it off the books for the same amount we put it on the books for. Now, more than likely, you're going to have a difference in the selling price or the issue price versus what you had to pay to get it back. So that will go to a paid-in capital account. Paid-in capital from sale of treasury stock. The difference with this paid-in capital account is you can debit it or credit it because let's say they bought the shares back at $50 a share, but when they got ready to resell them on the market, they dropped and they can only get 40 for them. They got to get the 50 out of the treasury stock account, but they lost money. So that loss of money will go into that paid-in capital account. And y'all will see when we do examples. When dividends, stock or cash are declared, no dividends are paid on treasury stock shares. So treasury stock, because the thing is, if the corporation pays dividends, they're not going to pay dividends on the treasury shares. That's like writing themselves a check. They're the owners of those shares. So they're not going to pay dividends on those shares. Does that make sense? Okay. All right. So, I mean, the next thing is treasury stock example. So we can hit that next time. Or we can hit it now. It's up to you. All right. Y'all do your homework. Read. Your reading is on treasury stock, so you've got your answers on here. There's really not a lot to read anyway, and we just went over it. So just take your quiz and do your homework. Plan on your test being a week from Thursday. You have 10 days to prepare.
That's a quick turnaround.
Yeah, this chapter, in this class, we're only doing one chapter at a time because there's so much in each chapter, so it does, you do seem to have them more frequent. You'll have more tests in here because we're covering one chapter at a time. It's testing one chapter at a time. Where is it? Where's my stop?